I would like to welcome everyone. My name is Grzegorz Ekiert. I'm Professor of Government and Director of the Center for European Studies. This is a very special event, and this is not a very special event because we have a very distinguished speaker today, but this is also inaugural event for the new program at the Center for European Studies, which we call the European Economic Policy Forum. That new program will create the space and open the opportunities for us to discuss the most pressing and interesting issues in European policy today. We had a number of events over the last year or so in which the interest of those policy issues was very high, so we want to really keep that interest going. This program is going to comprise a number of things. There will be visiting fellowships and residential fellowships. There will be annual European policy forum, and this program is coordinated by the committee, which includes Peter Hall, Rawi Abdullah, Hans-Helmut Kotz, and myself. We hope to raise funds for this program, but we decided to start it even when the funds are not fully in. We couldn't pass on the great opportunity, so because this is a special event, it will be 3 introductions. That's how you judge the special events. And we could not be more fortunate than to have Dr. Jens Weidmann as a speaker for this launch of the program. So first, Hans-Helmut Kotz will introduce our speaker, and then Professor Benjamin Friedman will be moderating the discussion. So welcome you all, and I'm so grateful for this opportunity we have hosting you here at the center.
So, good afternoon also. It's not for reasons of getting a hand at the seniorage of the Bundesbank that we have invited Dr. Weidmann. And I'm supposed to introduce him because I'm probably know him for the longest time. And I'll do it very briefly. Jens is a real European. He did his undergrad studies at Aix-en-Provence, Marseille. And he did his grad studies and PhD at Bonn University, and then moved on to the IMF, where he spent 2 years, and he was working there in particular on corruption, natural resources. And later on from there, broadened out largely his horizon. He was General Secretary of the German Council of Economic Experts, and in particular in 2003 responsible for the so-called 20-point program. From there he went to the Bundesbank. He was one of the youngest ever, I think youngest, head of departments, head of division, later on head of departments, and then for 5 years the head of department at the Chancellery. In fact, he was the chief economic advisor to Chancellor Merkel between 2007 and 2011, and in that role also G7 and G20. G8, G7, G8, G20 Sherpa. And since 2011, he is president of Deutsche Bundesbank, and in particular trying to steer European monetary policy along the lines which one would assume a principled Bundesbank president would do. Without further ado, Ben Friedman.
Thanks, Hans-Helmut, and let me first add my own personal welcome to our very distinguished speaker. We're delighted to have Dr. Weidmann with us. Welcome to New England, welcome to Harvard, welcome to the Center for European Studies. Second, I'd like to remind everyone here that this session is on the record. That is on the record. There are press present, and the rules are that anything that anybody says is fair game for the press. Now, I want to congratulate the Center for European Studies for not only staging this event, but doing so in a way that is calculated to bring out what Europe and the United States have in common. Namely, as Professor Eckert has explained, this is part of a program that has not yet been funded. And so the money is being spent despite the fact that there is no money to be spent. And this is a gesture, Jens, toward your understanding the commonality between Europe and the United States. We do have, for all of the differences, which I assume will come out in the discussion, there are things that we do have in common. And so, but I hope everybody understands the message clearly of being invited to a Harvard event where a new program is being launched, but the funds are not yet in hand. As the late Professor Gomes said in his inimitable New England accent, which I can't quite replicate, "You know why you are here." Now, there's much to discuss, and I want to put a few issues on the table. Dr. Weidmann is going to be discussing the topic of making Europe prosperous. That's Europe, not Germany, prosperous. Presumably one could do that by digging a big trench and floating the southern tier countries off into the Atlantic so that they can attach themselves to some other continent. But I'm guessing, Jens, that's not what you mean. And so we're going to be interested in your proposals for achieving this remarkable feat. As people, I hope, are aware, Europe now has, the Eurozone as a whole now has the largest, highest unemployment on record, namely 12.2%. And at the same time, inflation in the Eurozone is now the lowest that has been recorded in the last 4 years. Inflation is just 0.8%. Many people are concerned about risks of deflation. Many people are concerned about risks of renewed recession, and I assume we're going to talk about all of those things. People are also concerned about the risk of political breakdown in the southern countries, and we've seen some of that just within the last week. The question is, how far down can one oppress certain people without generating a response, and then what does the response look for? At the same time, some people are concerned in Europe, as they are here. I think of my economics department colleague Jeremy Stein, who's been especially articulate on this subject in his capacity as a member of the Board of Governors of the Federal Reserve System. Some people are very concerned about the possibility in the other direction of excessive risk-taking being spurred by what is now nearly a half a dozen years and counting of zero interest rates. There are issues in a European context to discuss as well, having to do with things that we do not face in the United States, namely the consequence of having a monetary union without a fiscal union. Question of who is it that bears the cost of bailing out the banks? Who is it that bears the cost of bailing out countries? There is a view that the Greeks, for example, are performing a very valuable service. The drill is that mostly German and to a lesser extent French taxpayers have been bailing out mostly French and to a lesser extent German banks. This is all done, of course, without admitting that it is so, and the vehicle that allows it to happen without admitting that it is so is that the Greeks are allowed to touch the money for a few seconds while it passes from the taxpayers to the banks. Many people feel this is a very valuable service that the Greeks are performing, and they should be compensated accordingly. At the same time, the question that we could discuss is why is it that the Europeans, in the context of the crisis that they have had, seem to have equated the event of a default on one's sovereign obligations with an exit from the currency union. We crossed that bridge a long time ago in the United States. In the most recent bond market problems that we had here a few years ago, nobody would have thought that if, for example, Illinois had defaulted on its general obligation bonds, Illinois would on that account have been obligated to leave the dollar currency area, and yet that seemed for a while at least to be the common assumption underlying the structure in Europe. And then finally, there is the whole issue on which I know that Dr. Weidmann has very interesting views of banking supervision and banking regulation. We, of course, in the United States have completely given up on that front. We make no effort anymore even to pretend that we either regulate or supervise the institutions that we dignify with the label banks. But the Europeans seem to be serious about this, although there is some disagreement about how to go forward. And as I say, I know Dr. Weidmann has views on this. So there is much, much to discuss. The plan going forward is that Dr. Weidmann will offer remarks, perhaps for a half hour, 45 minutes. Whatever you would like to take is fine with us. And then after that, we'll have a general discussion to which everyone is welcome to participate. So, Jens, welcome to Harvard. We are delighted to have you. Thanks a lot.
So dear Hans-Helmut, thanks a lot for arranging this dense program for me and all these stimulating interactions. Dear Professor Friedman, I'm very grateful to your kind introduction, which also sets out room for debate, I would say, after the short speech. Ladies and gentlemen, it's a pleasure to me and an honor to speak here today to you. And I wanted to start with a quote from one of your former presidents, Harry Truman, who is said to have asked to be sent a one-armed economist, and I guess all of you are familiar with that quote, as he was tired of having exponents of the dismal signs proclaiming on the one hand this and on the other hand that. And today it sometimes seems like the opposite is true. In the eyes of many politicians, economists, at least if they are central bankers, cannot have enough arms now, arms with which they are to pull the levers to simultaneously deliver price stability, lower unemployment, supervise banks, deal with sovereign credit troubles, shape the yield curve, resolve balance sheet problems, and manage exchange rates. And it's probably safe to say that this change in attitude is not just due to a sudden surge of popularity of economists and central bankers. And Raghu Rajan, the former IMF chief economist and now a colleague at the Central Bank of India, has quipped that central bankers now have the popularity of rock stars. I'm not sure that he feels a bit different now that he's in the shoes of a central banker. But rather, this reflects the widespread view that central banking has come to be the only game in town. And quite a few economists seem to agree with this very notion. To some, the notion that the primary goal of central banks is to keep prices stable has become old-fashioned. Against the backdrop of the financial crisis, they argue that financial stability has become just as important, if not more so, than price stability. Consequently, many contend that the central bank's role as a lender of last resort applies not only to banks, but to sovereigns as well. And this demand is aimed particularly at the European Monetary Union. But such a move would run counter to the current institutional framework under which fiscal policy remains a national responsibility and under which, for this and other reasons, the Eurosystem is forbidden from financing European institutions or member states. To others, the idea of central bank omnipotence is illusory and fraught with risk. If financial and fiscal concerns dominate central bank decision-making, it is no longer independent in its decisions on how to keep prices stable. Omnipotence then turns into impotence. So the question remains, how do we make the European Monetary Union robust and resilient? It's a bit less ambitious than the title you presented, to be quite frank, so I want to lower expectations here. In my remarks, I wish to argue that by piling more and more stabilization tasks onto monetary policy, stability will prove ever more elusive. What seems to be true in general holds especially within the specific setting of European Monetary Union. Rather, we need to make sure that the functioning of EMU as a whole is shielded from the failure of one of its constituent parts, be it a bank or a sovereign. That's one of the points you have been making. Former Italian Prime Minister Mario Monti once said, Germans view economics as a branch of moral philosophy. I'm not sure whether he meant this as a compliment, but John Maynard Keynes probably would have taken it as one. For him, an economist must, and I quote now, possess a rare combination of gifts. He must be a mathematician, historian, statesman, and philosopher. So at the risk of confirming Mario Monti's suspicion, I will seize this opportunity to be a Keynesian. I will try to illustrate the economic rationale behind the Bundesbank's approach to monetary policy by borrowing from political philosophy. And maybe Mario Monti will let me get away with it after all, since it is a concept from political rather than moral philosophy. The concept I'm referring to is Michael Walzer's art of separation. According to him, liberties are created by walls between the different spheres of society. In pre-liberal times, and I quote, church and state, church, state and university, civil society and political community, dynasty and government, office and property, public life and private life, home and shop, each pair was mysteriously or unmysteriously two in one, inseparable. Confronting this world, liberal theorists preached and practiced an art of separation. The wall between church and state creates a sphere of religious activity, of public and private worship, congregations and consciences into which politicians and bureaucrats may not intrude. Similarly, again, the separation of civil society and political community creates the sphere of economic competition and free enterprise, the market and commodities, labor and capital, end of quote. The walls of liberty concept can be applied to explain the success of independent central banks in fighting inflation as well. Assigning central banks a specific responsibility and granting them independence gave central banks the freedom to concentrate on the one objective for which they had the tools to achieve it. Many scholars, among them Alberto here and Larry Summers, have shown empirically that having an independent central bank amounts to one of the rare free lunches in economics, benefits in the form of low and stable inflation, but no costs in terms of growth. By tearing down the walls between monetary, fiscal, and financial policy, the freedom of central banks to achieve different ends will diminish rather than flourish. Put in economic terms, monetary policy runs the risk of becoming subject to financial and fiscal dominance. Let me explain these mechanisms a bit more in detail, starting with financial dominance. The financial crisis has provided a vivid example of how financial instability can force the hand of monetary policy. When the burst of an asset bubble threatens a collapse of the financial system, the meltdown will, in all likelihood, have severe consequences for the real economy with corresponding downside risks to price stability. In that case, monetary policy is forced to mop up the damage after a bubble has burst. And confronted with a financial system that is still in a fragile state, monetary policy might be reluctant to embrace policies that could aggravate financial instability. And this underscores the importance of a well-capitalized and tightly supervised financial system, a precondition for stable prices which monetary policy cannot establish, and which is the responsibility of other policymakers instead. The contribution of monetary policy is by seeking, through conducting a more symmetric monetary policy, to prevent financial turbulence which could pose a threat to price stability. But often the interest rate might prove too crude an instrument. It might not be efficient to punish the whole economy for the exuberance of a single sector. And therefore, financial policy needs its own toolbox. According to the first Nobel Prize winner in economics, Jan Tinbergen, every economic policy objective requires its own instrument, otherwise success will be uncertain. And by heeding his advice, we are practicing the art of separation. Strict financial regulation and supervision is needed to increase the resilience of banks and the financial sector as a whole. And macroprudential instruments provide solutions more tailored than the interest rate can offer. Unconventional monetary policy measures, such as the very long-term provision of liquidity to banks or forward guidance that the central bank interest rates will not be increased within a foreseeable time frame, cannot eliminate these problems. Their contribution to monetary policy is that they represent possible actions, even in cases where the boundaries of interest rate policies have been reached, if interest rates are near the zero lower bound, or if the stimulus from interest rate cuts is not transmitted to the real economy. To avoid any misunderstanding, this, in my view, does not mean that central banks have no role to play in financial stability, but the necessary separation pertains to the policy and not the institution. But does it mean, for example, that the decision-making body but it does mean, for example, that the decision-making body responsible for monetary policy should not be in charge of supervising banks as well. In Europe, under the current plans, the ultimate responsibility for the new European banking supervision mechanism will rest with the ECB Governing Council. To avoid possible conflicts of interests, this should not become a permanent solution. A change of the European treaties is required to allow for a body other than the Governing Council within the ECB to have the final say in supervisory matters. And if this avenue is not taken, an independent supervisory institution will become necessary, in my view. When it comes to monetary and fiscal policy, however, the separation should go a little farther even. Mervyn King once quipped that central banks are often accused of being obsessed with inflation. This is untrue. If they are obsessed with anything, it's with fiscal policy. Let us delve a bit into the origins of these rare obsessions of central bankers. Public debt and inflation are related on account of monetary policy's power to accommodate high levels of public debt. Thus, the higher public debt becomes, the greater the pressure that might be applied to monetary policy to respond accordingly. Suddenly, it might be fiscal policy that calls the shots. Monetary policy no longer follows the objective of price stability, but rather the concerns of fiscal policy. Then a state of fiscal dominance has been reached. Technically, fiscal dominance refers to a regime where monetary policy ensures the solvency of the government. Practically, this could take the form of central banks buying government debt or keeping interest rates low for a longer period of time than would be necessary to ensure price stability. Then the traditional roles are reversed. Monetary policy stabilizes real government debt, while inflation is determined by the needs of fiscal policy. For monetary policy to deliver price stability, it is ultimately dependent on a sustainable fiscal policy. And this is why acting as a lender of last resort for governments can prove a very slippery slope. If governments can expect to be bailed out by central banks, chances are that they will adjust their behavior accordingly. And in the euro area, a lender of last resort role for the euro system does not square with the institutional architecture. The monetary union differs from other currency areas in one very crucial aspect. While monetary policy is a common undertaking, fiscal policy remains a national prerogative. Evidently, the unsound fiscal policies of one member state can have repercussions on the Union as a whole. Conversely, the negative consequences of bad policies can be better externalized to the rest of the currency area, and thereby undermining the incentives for sustainable policies. To mitigate these risks, precautions were taken in the form of fiscal rules, the no bailout clause, and the prohibition of monetary financing. The guiding principle of these rules was self-responsibility. Member states are free to pursue their own fiscal policies, but they are subject to common rules and market discipline. And at the end, they are liable for their own decisions. A lender of last resort role would violate the principle of self-responsibility in the same way as Eurobonds in this setting are at odds with it. And therefore, it would aggravate rather than alleviate the problems besetting the euro area. So, if monetary policy cannot disentangle the euro area's fiscal and financial conundrum, what can? Central to any stable framework is a balance between liability and control. Those who act must also be liable for their actions. Substantial measures were taken to contain the sovereign debt crisis. These measures, notably the two European stability mechanisms, the EFSF and the ESM, stabilized the euro area in the short term by offering financial assistance in exchange for structural reforms. And this approach of buying time for adjustment is also bearing fruit. Current account imbalances have improved structurally, and fiscal deficits have been significantly reduced. But in the process, the balance between liability and control has been thrown out of kilter. While fiscal policy remains essentially a national domain, liability has been increasingly transferred to the European level. Going forward, the balance between liability and control has to be restored. Otherwise, the hard-fought gains in fighting the crisis will come at the expense of new vulnerabilities. One possible option to balance control and liability would be a true fiscal union. That is, a transfer of fiscal decision-making powers to the European level. And in 1963 already, one of my predecessors, Karl Blessing, even said that, and I quote now, "A common currency and the federal central banking system are feasible only if, apart from a common trade policy, there's also a common fiscal and budgetary policy, a common economic policy, a common social and wage policy, a common policy all around." In this scenario, control and intervention rights would be shifted to the European level. And if this prerequisite were fulfilled, a greater mutualization of liabilities would become feasible and may also be justified. But this would require not only changes in the EU treaties, but also changes in the national constitutions that are underpinning our national laws. But judging by the reluctance of governments and electorates to let Brussels have a say in fiscal matters, this avenue seems blocked, at least for the foreseeable future. And one very telling reaction to the Commission interfering with national matters is President Hollande's response to the European recommendation for reform in France. And I quote here, "Elle n'a pas à nous dicter ce que nous devons faire." The Commission cannot dictate to us what we have to do, which is quite, I think, symbolic of how do we treat the advice from Brussels sometimes. So therefore, the answer is, in my view, to reestablish the principle of member states' individual responsibility, which means going back to a strengthened Maastricht framework. In other words, it is to practice the art of separation. To strengthen the framework laid down in the European treaties implies stiffening the fiscal rules, which were bent and ignored too often in the past, with Germany also being one of the culprits. The new Stability and Growth Pact is thus a step in the right direction. But the mere existence of these rules will, of course, not suffice. We need also to actually apply them. And the European Commission is responsible for enforcing them. However, up to now, the Commission has adopted a rather, I would say, lenient interpretation of the new rules. In addition to stronger rules, we need to make sure that in a system of national control and national responsibility, banks and sovereigns can default without bringing down the entire financial system. Hence, breaking the sovereign bank doom loop will be central to solving the euro area crisis. What does this mean more concretely? In the crisis, this sovereign bank nexus has developed into a vicious circle. Wobbling banks and stumbling sovereigns clasp at each other to avoid falling, but are in fact dragging each other down. If many banks get into trouble at the same time, possibly due to the burst of a large asset bubble, financial stability as a whole is threatened, and the state then often has no other option but to step in if it wants to prevent a meltdown of the real economy. But this rescue can be a huge burden on government finances, and this is what happened in Ireland, where the need to prop up the financial system pushed up the public debt ratio by nearly 30 percentage points. Conversely, weak government positions can destabilize banks directly through their exposures to sovereign bonds and indirectly through worsening the macroeconomic conditions, and this was the case in Greece. So how can we break this doom loop? With regards to spillovers from banks to sovereigns, we need to make sure that taxpayers do not foot the bill when banks run into problems. The strengthened Basel III capital rules are a first step in that direction, as they increase equity buffers and therefore the capacity of banks to absorb losses. The banking union, with its single supervisory mechanism, is another one. Strict and stringent supervision ensures that tough rules are equally applied to all. The single restructuring mechanism currently under discussion is necessary in order to establish a bail-in regime that assigns a clear hierarchy of creditors. Only then will credit costs adequately reflect credit risk, and shareholders and creditors, instead of the taxpayer, will be the first in line to bear banks' losses. But the bank-sovereign nexus goes both ways. We also have to address spillovers from sovereigns to banks. We therefore need to end the preferential treatment for sovereign debt. The Basel capital rules allow governments' bonds issued in domestic currency to be given a zero risk weighting. But with regard to the euro area, the assumption that all sovereign bonds are risk-free means that all bonds are treated alike, regardless of fundamentals. And this, of course, calls into question market discipline and is obviously not in line with recent history. Hence, sovereign bonds should be adequately risk-weighted, and exposure to individual sovereign debt should be capped, as is, by the way, already the case for private debt. An adequate risk weighting for sovereign bonds would make banks more resilient if the fiscal position of the respective sovereign were to deteriorate, and it would bring spreads more into line with the underlying risk, thus giving a disciplining signal to the respective sovereign. In an interview with the German newspaper Die Welt, Ken Rogoff pointed out that the adequate risk weighting of sovereign bonds constitutes a far more effective debt brake than ever any fiscal rule could. Besides, many European banks hold bonds from one sovereign only. This is their home country. Large and undiversified exposure is what makes sovereign default a potentially systemic event. Hence, the large exposure regime, which caps the investment in one single debtor, has to be applied to sovereigns as well. Ending the preferential treatment of sovereign debt would greatly reduce the risk of a financial crisis in case of a sovereign default. It would therefore go a long way towards re-establishing the principle of individual responsibility in fiscal affairs. Ladies and gentlemen, let me conclude. The idea of monetary policy safeguarding stability on multiple fronts is alluring. But by giving in to that allure, we would likely end up in a world even less stable than before. This holds true especially for the euro area, where a euro system acting as lender of last resort would upend the delicate institutional balance of the monetary union. To disentangle the euro area's fiscal and financial conundrums, we should practice the art of separation, especially with regard to the sovereign bank doom loop. Or let me put it this way, rather than for monetary policy to waltz with fiscal and financial policy, we need to erect walls between banks and sovereigns. Thank you very much for your attention.
Well, thank you very much. This is on? Good. Thank you very much, Dr. Weidmann. You've given us an enormous amount to stew on and to contemplate, and you've been not only very clear in what you have in mind, but very specific and concrete. I counted at least 5 elements of new regulation of lenders, and let me assure you that in this university we are very supportive of the idea that economics is, of course, a branch of moral philosophy. It began that way in Scotland, and we maintain the tradition. Adam Smith never, ever called himself an economist and never, ever had an appointment with the word economics in it. He was, of course, a professor of moral philosophy. So we've talked about the need to separate fiscal and monetary affairs, to erect, as Dr. Weidmann says, walls. We talked about the need for bank supervision and the need to disentangle the banks from their symbiotic but corrupt relationship with their sovereigns. We talked about methods of regulating banks. There's much on the table. So what I'd propose is that for the discussion, we'll have someone who wants to volunteer lead off on one subject, and then maybe instead of jumping from topic to topic, we can stick on one topic for a few rounds of questions and then move on to the next one. So, Professor Schleifer?
So I think I understand.
There's a microphone going around.
I believe I understand what you're proposing as a change in architecture, but I'm curious about your thoughts of how we go from here to there, in the sense that it seems to me that the minute that the ECB stops subsidizing European banks, they go under, which is going to lead to all kinds of dramatic consequences for European economies. If it stops, if you change the rating systems on sovereign debt, you have sharp increases in interest rates, and again, you're going to have a further crisis in the European economy. I think even with the current subsidies, the growth prospects for Europe are mediocre at best. So I was wondering whether you could comment on not what your idea of, not just on what your idea of a desirable architecture is, but what you think is going to happen in the next 2 or 3 years, and why you think that the continuation of the existing policies is avoidable.
Thanks for the question, and before you answer, let me just remind everyone, this is meant for you, this meeting is on the record, and anything that's said is fair game for the journalists present.
I think the danger is that we fall victim to the principle of the unripe time. There's, of course, never a good time to change things. If the times are good, you don't discuss the problems. If the times are bad, you aggravate the situation. So in that sense, it's perfectly clear to me that, of course, all the changes I've discussed today, but also going beyond that, can only be implemented with an appropriate transition time, because they have the potential to aggravate the crisis. But on the other hand, there is another risk. The risk is that by accumulating, I would say, a succession of crisis measures that undermine the institutional framework of monetary union, that are all well-intentioned, basically to calm the current situation. We end up in an institutional setup that will not work in the long term. So there is this, I would say, inherent tension between what we need to do or what we think is useful in the short term to cope with the direct consequences of a crisis, on the one hand, which is oftentimes in contradiction to what is right in the long term to make the monetary union work. And I think the art or the challenge is how do we organize this transition? But I don't think that we are up to that task if we don't even discuss the long-term issues that we are facing. I think if we don't manage to agree on that now, if we don't manage to agree on a transition time, it will probably not happen, and we will be facing a situation in a couple of years' times where the same problems will haunt us back. And then people will ask us, why didn't you change it? Why didn't you react? So it's not a perfectly satisfactory answer to you, I think, because it was not as concrete as, I guess, some parts of the speech. But on this regulatory treatment of sovereigns, for instance, I think we can agree on that now. It's perfectly, I think there's nobody contesting that this is something sensible in the long term, and then we let us discuss the transition period towards that. I mean, it cannot be that you kind of perpetuate the let's say, subsidies that you described to maintain the calm in the system in the long run.
And other than the treatment of sovereigns, would you like to offer the prospect that anything else on your list is likely to be achieved or potentially achievable within the next, what did Andre say, 2 to 3 years? Anything else on the list that we could look for?
Well, I think the banking union is something that is on our agenda, that is progressing as we talk, and that is also meant to address one of the issues I've mentioned, namely the bank sovereign nexus. So in that sense, there are also measures that we are implementing currently that help us to, let's say, enforce this principle of self-responsibility at the end.
Any other questions on the question of immediacy and implementability over the near term? Otherwise, Professor Ferguson, did you have a question?
Well, first, thanks for an excellent speech, and apologies for missing our lunch date for personal reasons. Let me ask a question I would have asked at lunch. It's somewhat similar in its premise to the first question. When I listen to the list of things you suggest, stiffen the Maastricht fiscal rules, make bail-ins for banks necessary if they become insolvent, make sovereign bonds properly risk-weighted, end preferential treatment of sovereign debt. I'm thinking like Professor Schleifer, what, now? When the talk is all of deflationary risk? My question, though, is somewhat different. It's a question about Germany and the inflation fear. The most extraordinary chart that I saw this year was from Der Spiegel, and it related to concerns amongst German voters about inflation. This was the number 2 concern that German voters had this year. And it seems to me that at the heart of the Eurozone crisis is this inflation psychology of Germans. You yourself quoted Goethe in a famous speech on the subject of the inflation dangers of exceptional policy measures. Are you not yourself contributing to an inflation psychosis which is unwarranted when we should be far more worried about deflation in the Eurozone?
Yeah. I mean, on your first remarks, coming back to yours, again, I don't think that there's ever a good time to introduce something that where you have some people paying the price for it. So there's never a good time. So you can debate when to discuss this. I think it's obvious that we need these changes. So if you have a transition time, you can probably cope with the consequences. On your second point, I mean, I'm glad that you think that my speech in this very familiar Frankfurt setting is famous by now. I think you have to put this speech into context to really not distort the message. This was the Goethe year in Frankfurt. So the topic that I was given was to talk about Goethe and money. And as you might know, Goethe was a finance minister in Weimar. In Goethe's Faust, you can find, very interesting parts on money creation. So, obviously, I think for me, I try to talk about Goethe and money. And I wasn't really creating a parallel with current developments. But on the other hand, the point that I was making is that in a way we also always think that this time is different. And the debate sometimes is, in my view, skewed in that respect, that we think this time we can get away with completely different functioning of the economy. Normally, the economy haunts us in the sense that it reminds me of this debate about the new economy, where with all these nice papers arguing that now this is a different growth trend and so on, and we are now on a different growth path. At the end, we found out that it wasn't the case. So in a way, but this is a different part. I'm deviating now. On your point of inflation, I think you are right. At this juncture, for the euro area as a whole, we have, of course, a debate that is not so much concerned with inflation, but rather with deflation. But also there, we have to, I think, look a bit behind the headline figures. What is deflation? For me, deflation is a self-sustained, expectation-driven process that drives down prices very broadly. What we are seeing, at least with regard to the latest HRCP figures that we have received, is that energy prices played a huge role, that the VAT pass-through in Italy played a huge role, and of course that the adjustment processes in some of the countries under pressure played a huge role. And I wouldn't label this deflation. I would label this an internal devaluation to regain competitiveness and a necessary internal devaluation. So I think there is, if you want, nervousness on both sides of the spectrum. I don't know the Spiegel numbers you've cited, you've quoted, but I guess you're right in the sense that the German public is probably like any other public, influenced by its own past to some extent. And we have experienced in Germany periods of massive currency devaluation or massive inflation, and we have experienced a long time of, let's say, a very stable, successful currency, and that shapes, of course, the thinking of the people. And so in part, this explains, I think, some of the approaches towards the discussion, but I wouldn't say that this has any impact on our debate within the governing council at the end.
What about the real counterpart to the question, though? And if even if we might be confident that we're not going to get into this cumulative, self-sustaining, expectations-driven deflation that you described, what about the prospect that the nascent recovery in Europe is going to falter? One hears a lot in various markets about concerns of potential renewed recession. Is this something we should take seriously?
Well, our target is to maintain price stability, and we define price stability as an inflation rate close to but below 2%. And what matters for us is not the inflation rate of yesterday, because with all mightiness, we're still not able to influence the past. But the inflation rate 1.5, 2 years ahead. And if you look at the forecasts that are or if you look at our projections, if you look at market forecasts, I think the likelihood of a deflation is judged pretty low. The latest figures I haven't had is that the Survey of Professional Forecasters attaches a likelihood, I think, below 1% to deflation in the euro area as a whole. Our forecast is hovering around 1.5%, which I would say is pretty close to that definition of price stability. Of course, you can imagine other scenarios, but the question is how likely are these, and shouldn't we base our monetary policy making at the end on the most likely scenario and not on the unlikely scenarios. And our forecast, I mean, our projection regarding growth is a gradual recovery. All the incoming data so far is confirming that picture, so I don't see any need to revise that forecast. And you will see when we'll come out with our projection in December, the revisions probably to the real side of these projections will be quite minimal.
Who else would like to weigh in on this issue of inflation, unemployment, recession? Bob Kuttner?
The students are not asking many questions here.
Excuse me?
It's all the professors asking questions.
I wanted to call attention to another episode in German history and see if it was part of the consciousness of the leadership of the German government. And this concerns the currency reform of 1948 and the write-off of 93% of the Nazi-era debt in the London Conference of 1953, leaving West Germany with a debt ratio of about 13% of GDP at a time when the Allies had debt ratios of over 200 in the UK, over 140 in France, still close to 100% in the US. Now, at the time, there were voices calling for policies of austerity to be visited upon Germany, not to help Germany heal, but to keep Germany in a state of destitution. And although the Greeks committed a number of sins in fudging their books, you know, you weigh those sins against the sins of Hitler, some would say it's a close question, but I think Hitler's were probably worse, and yet the Allies, partly cognizant of the tragedy of Versailles, partly cognizant of the threat of Stalin, decided that it made more sense to allow Germany to recover. And I just wonder if there's any consciousness of that history when the German leadership looks at the malefactors in Greece, in Portugal, in Spain, in Italy, and weighs the risks of real destitution and depression against the benefits in principle of fiscal and monetary rigor.
Well, I think comparing anything to the atrocities of the Nazi regime is not, I think, helping you in any way to cope with the European debt crisis.
But there was an act of macroeconomic mercy that the leaders of the West felt was sensible, notwithstanding the history.
Yeah, but let me just finish my reply, and then I guess you can ask another question or add your comments. I think your portrayal of the German position is a bit unfair in the sense that Germany is carrying a huge burden in the stabilization of the euro area these days, contributing to the rescue mechanisms, for instance, which allow an adjustment process that is much smoother and softer than that would have occurred without these rescue mechanisms. So in a way, what you're asking for is happening. And now you can debate whether the pace of adjustment is too quick or too slow, but that's, I think, rather a matter of degree than of any qualitative issue. So what you're asking for is happening, and I think that was my point in the presentation. I think what is often overlooked when you comment from this side of the Atlantic is that the institutional setup of the monetary union is a very intricate one. And by communitizing debt, you create a precedent in our setting that will not lead to everybody else saying that, listen, this is a one-off game, but it's unfortunately a repeated game. As you could see, it will, or as you could observe during the crisis, it will rather lead to further demands of doing the same thing to everybody else. You have 17 members, and they will all ask for equal treatment. And then you have a much, I would say, more complicated discussion, especially if you then assume that with this you of course create also the framework for the institution going, or the monetary union going ahead. Now I'm completely abstracting from let's say the legal framework that we are having in the treaties and in our national constitutions, which make things, or which is also something that you shouldn't neglect in your debate here. We cannot create something from scratch here. We are bound by our constitutions, bound by the EU treaties.
Others on the issue of either bailing out the Greeks, not bailing out the Greeks, is enough being done for the southern tier countries? Professor Alesina? From a southern tier country?
But sort of linking the previous question to the question that Andre was asking a moment ago, it seemed to me that you're right, that doesn't seem to be never the right time for changing the rules, but certainly a time which is wrong to change the rule is in the middle of the game. So when you're playing a soccer game and all of a sudden you change the rule in the middle, it's a bit complicated. And it seems to me that the euro has done exactly that. You know, we created the euro. We had no idea about with what rules about fiscal policy, and for 10 years we were doing nothing because we thought that everything was doing great. And now we find ourselves in a situation in which we have to change the rules, but when we know very well who's going to win, who's going to lose by the changes of the rules, and that would make it very extremely difficult. For example, there was a rule that the sovereign debt was completely non-defaultable, so much so that European Central Bank was buying Greek debt or treating Greek debt as German. I mean, the market were treating Greek debt and German debt pretty much in the same way.
But what rule are you referring to?
What
was the rule that was prohibiting a government in Europe from defaulting?
Well, the treaty says that that there is no default of a sovereign.
Where does the treaty say that no sovereign can default?
That was the.
I would say it's a I would even go in the opposite direction and say it's a constituent element of the treaty that sovereigns must have the possibility to default at the end, because otherwise this whole framework is not working. Then if sovereigns are not allowed to default, then you have no market discipline, and so on.
Right, but why did the market discipline did not apply? Because there was a sense in which that the treaty, I misspoke, that the treaty would not be really enforced in the sense that in the end.
Exactly.
In the end, we're right. But my point, going back to one of the questions, my point is that we are trying to change the rules when we know who is going to win and is going to lose.
You gave the answer to your question, because we have a treaty, we agreed to certain rules, and the rules have been changed during the game by applying them in a specific way or by not applying them. So in that sense, I think I would even agree with you. The markets had the assumption that there would be no default, that probably at the end that turned out to be right, that their assumption that there would be a bailout, probably. But that was not what was initially the intention of the treaties. So in that sense, there's a continuous evolution of the game, or of the rules of the game. And to say that now these suggestions that I made to, in a way, bring back the interpretation of the rules, or the rules more in line with the initial Maastricht framework, are now the ones that can absolutely not be applied because it's a change in the middle of the game, I find is not convincing. Because all the crisis mechanisms changed the rules of the game, for instance. We even changed the treaty, by the way, to that respect, to make let's say, this partial bailout more in line with 136 of the treaties. There was an addition to that article of the treaties to allow this sort of operation. So there's a continuous change. We're changing the rules of the game since we are Europeanizing supervision. We are changing the rules of the game since we are introducing a single restructuring mechanism. We're introducing a different hierarchy of bail-in. So there's a continuous change. And all these changes benefit some and probably less others. But my point is, this is one aspect, but for me the crucial aspect is, does the system in the long term work? This is for me the key driving force.
How about this presumption that I don't think it's in the treaty, but the presumption that I mentioned before, in which at least for a long period of time during the crisis, it seemed to be the working presumption in Europe that if the Greeks defaulted in a formal, recognizable sense, then they would have to exit the monetary union. Can you say something about where that comes from, what the logic about it is, whether now that the Greeks have in effect defaulted and with the blessing of everybody else, do you think that the formal presumption is now gone? Can some member country of the monetary union now do what our states occasionally have done? Just tell creditors, terribly sorry, but you made a bad investment, and as a result of making a bad investment, you're not going to get your money back. Could they do that now and stay in the union?
Well, first, we at the Bundesbank never shared this presumption. But you're right, it was out there, and I think for two reasons. One, of course, is the perception that was linked to a sovereign in Europe defaulting, and the changes it would trigger in also I would say, the assessment of other sovereigns in that area. This is one, and you can debate whether this is sensible or not. And the other one is the point I was making in the speech, which is the bank-sovereign nexus. If you have a banking system that is full of your sovereign bonds, then of course default of that sovereign completely or leads to, let's say, a meltdown of your financial system. You would not have a financial system that would work in that sense, and that's why severing this bank-sovereign nexus also helps in allowing a constituent element of our, I would say, of our institutional setup, which is allow banks and sovereigns to fail.
Okay. Now, there was a question over here before. Yes, please.
Thanks. So thank you very much for a really fascinating speech. I have a question about the...
There's a microphone coming.
Thank you. Thanks again for a really fascinating speech. I have a question about the art of separation. So, former ECB chairman Trichet used to like to talk about living in a single needle universe. He had a single needle in his compass, and that was price stability. And you think you've echoed that essentially with your comments this evening. However, as I read the treaties of the European Union, the ECB is legally mandated to support the economic goals of the European Union, including employment growth and GDP growth, without prejudice to its primary goal of price stability. And yet, it seems that that you and many other, and the Bundesbank in general, I guess, is critical of recent ECB decisions to, further loosen monetary policy. So I'm wondering whether, or just simply in light of your comments this evening about price stability being the only thing to be targeted by the ECB, I'm wondering whether you have a different interpretation of the treaties than me, or whether you simply think that perhaps monetary policy can't affect these other, real economic goals such as GDP or employment, or how you can explain that, or perhaps more simply put, do you consider 1% inflation or below 1% inflation at the eurozone level, record high eurozone unemployment, and essentially zero growth to be fulfilling the ECB's legal mandate?
So, of course, you're right. I mean, I think you had a very correct portrayal of the treaties. But it's also clear from the treaties that there is a clear hierarchy of our goals. We have just one primary goal, which is delivering price stability. And then once this is assured, we can also contribute to the other goals of the Union. But this should not lead us to think that monetary policy is a good tool to replace structural reforms. We cannot substitute with monetary policy what needs to be done in a lot of our countries, even my own, when it comes to the political processes that have to be the political decisions that have to be made. monetary policy will not be able to solve structural unemployment problems. Monetary policy will not be able to increase competitiveness of any single country on a let's say, protracted horizon. Of course, we can have a short-term effect on all these variables, but the question is whether it helps you in the longer term. And there's, of course, this interplay between monetary policy and other policy areas that is quite intricate. So that's why I think it's important that everybody assumes his or her own responsibility.
Does that mean to imply that in your view or in the view of the Bundesbank, the great bulk of the unemployment that's been seen in Europe, that we see in Europe now, is structural as opposed to the result of inadequate demand?
No, but it's linked to the competitiveness of these economies, and this is something that we cannot fix in the longer term. Of course, we can contribute to a weaker currency, but we've seen in the past that devaluating the currency doesn't really help you in a sustained way to reestablish competitiveness. I mean, take Italy as an example. You had numerous devaluations in Italy, and of course it helps in the immediate term, but it never helped you in the longer term. It just leads to the next devaluation. So in that sense, my point is that it's not a substitute for the structural reforms that are necessary in these countries. And even, I mean, these countries includes, in this case, I mean, Germany is only in a relatively good position these days. And I think by the crisis kind of distracts our attention away from the policy decisions that we need to take in Germany. So in that sense, I've gone out of my way in some of my last speeches to make clear that we face different problems in Germany that are more longer term, more related to our demographic challenges, but it doesn't mean that we don't have, we can, let's say, lay back and be we don't have to do anything in Germany.
I saw a question here, and then one there next, and then there third. So here, and then there.
Thank you. My question is on the macroeconomic imbalances that.
Can you speak up a little?
My question is on the macroeconomic imbalance procedure that the European Commission has generated, or at least has said it wants to look more in depth at the current account surplus of Germany, which is above 6%, and then in a way it links to the inflation psychosis, which was mentioned earlier, because the way out of this macroeconomic imbalance seems to be in part higher wages in Germany and boosting consumer demand in Germany, and therefore, in a way, tolerating higher levels of inflation in Germany. So my question would be, could you envisage a situation whereby the Eurozone average inflation is close to 2%, but higher in Germany? Is that something that would be acceptable, you think, for German public opinion and for yourself?
But I'm doing in the Governing Council monetary policy for the euro area as a whole. We are not having a monetary policy for Germany or France. And what you are asking for is already happening. I mean, just look at the latest inflation figures. They have been higher in Germany than elsewhere in Europe. And this is part of the adjustment process that is taking place. Wage demands in Germany then are higher than they have been in the past. And this is also only normal, given that the cyclical situation that Germany is in is completely different from that in many other countries. We are almost working at full capacity utilization, and this leads, of course, then also to higher wage demands and wage increases. So this is part of the adjustment process, and combined with these structural reforms and structural improvement of competitiveness of many other European countries, this leads also to adjustment in the current account. Behind the figures that you have been mentioned is a very, I would say, differentiated development within the Eurozone and outside the euro area. The current account surplus of Germany vis-à-vis the rest of the Eurozone has halved since the peak of the crisis. So this adjustment is taking place. Our current account surplus is mainly with the US and with China these days. And then if you want to have a debate on this, then I think you would have to debate whether a current account surplus or German exports to China or the US are benefiting the rest of the euro area or not. And you had recently the Spanish Minister of the Economy making a very clear statement about the, I think, benefits of these German exports to the US for the Spanish economy. Because the import intensity of these exports is way higher than many of the other components of German GDP, especially when you consider, for instance, fiscal spending programs. So I think, yes, of course, we have to undergo this new macroeconomic imbalances procedure. That is what we agreed. But then I think we need a thorough debate about the reasons behind this current account surplus. And then you need, so it's not that in Germany in any way is distorting competition. We're not manipulating the exchange rate. It's also, you also have to take into account that we are an aging society where you would expect a certain current account surplus. So the zero line is certainly not the benchmark. And then you have to discuss what are sensible measures to address. One thing that I think is to be addressed in Germany, which is the lack of internal demand and more particularly the investment weakness. So we have at the end to discuss measures to increase incentives to invest in Germany. And this is the right discussion to lead, not a discussion on how to artificially increase wages in Germany in which German government has no influence. Luckily in Germany, wages are the outcome of a completely independent wage bargaining process, like in the US. And I'm sometimes a bit puzzled by the recommendations we get to the government or to the public authorities to interfere with this wage bargaining process. I'm not sure how this could work at the end. And I'm also not sure that this will at the end really benefit the countries you have in your view. By the way, also, and if we're having this debate, then of course this might have a positive effect on the current account. In the longer term, this effect is much less clear, by the way. If you address this weakness in internal demand, especially if you address the investment weakness, I'm not sure that the long-term effect of this is that the current account will be permanently decreased.
Now, the next question was over here, and then next over there.
Well, Dr. Weidmann, thanks a lot for the speech. I think it was especially interesting for all the students in Professor Kotz's course, European Economics. Nice contribution there. I have a question concerning your vision of the size of the EMU. So we see Latvia coming up, and you talked about the difficulties the EMU is facing right now, the reforms. There might be some incentives that after the introduction, countries loosen their efforts to maintain a sustainable economic policies. So do you look forward to 2014 and welcoming a new colleague there and maybe some other colleagues in the near future? So would you say an expansion, or do you see the expansion of the EMU a bit more critically and would say that you should stick with the problems we have right now before integrating other members?
Well, since I know the colleague, I'm looking forward to working with him. And to reassure you, he's already sitting around the table. So in that sense, it won't be a huge change. But on a more serious note, this is at the end a political decision. The composition of EMU is not a decision of us central bankers. It's a decision of the elected governments. But the consequence of this is that governments also have to ensure the preconditions for the monetary union to be a stability union, or the preconditions for us to be able to deliver price stability, and thus to contain, I would say, the heterogeneity, to contain macroeconomic imbalances, for instance, to contain fiscal deficits. And this is then their responsibility. And if they don't live up to that, then we won't be able to deliver price stability. So this is the reverse side of them being in charge of choosing the composition of the monetary union, and they must be fully aware of the challenges that come with it, or the.
And then over here.
Good afternoon, Dr. Weidmann. Thank you very much for your speech. I wanted to use the chance to ask a question about the aspect of regulation of private actors in the financial system. I've noticed this may be rather a question for the president of the BaFin, but maybe you want to say something about that too. So we have seen lots of enthusiasm about regulation in the of private institutional actors in the last 2 or 3 years, and this was probably appropriate since these actors had a huge share in what caused problems that we are talking about today. But my feeling is that somehow this enthusiasm has diminished since 1 or 2 years. So my question would be why this has happened and what the status quo right now is.
I think in part you're right, in the sense that this regulatory process has lost a bit the political attention, or at least the attention of the highest political level. As you might remember, the whole regulatory process started as a G20 exercise. And there you could operate, of course, with very, I would say, illustrative targets, like each single operator, each single institution, each single market has to be regulated, and so on. This was the broad goal of the G20 exercise. And gradually, this issue has become more technical and has shifted also away from the G20 more to the FSB, where the actual regulatory proposals are worked on. And this means, I think, also that this whole endeavor has kind of shifted out of public focus, which doesn't mean that we are not working intensively on all these issues. But they're technically very, very complex, especially the interplay of the different measures is technically very complex and also needs an evaluation. Adding or let's say very tightly regulating one sector without taking into consideration that you will have it will lead to deviation into other areas would also be dangerous. So we need to continuously evaluate also what we are doing. There are 2 areas, I think, where efforts are currently being strengthened and where we still have some work to do, which is the too big to fail issue, and the other one is the shadow banking. Sector, and these are the issues we work most intensively on at the FSB level these days.
Bruce Monrad.
I'm going to be an apologist for the financial sector in my question. Certainly,
Mr. Monrad is the chief executive of a major Boston financial institution that, among other things, invests in bonds.
But I'm also going to be an apologist for the banks. Obviously there's an attractiveness to your moral hazard thinking and accountability. My question is accountability for what? And I'll ask it this way: is the financial sector, in U.S. terms, or is it supposed to be so strong that that actors are accountable for the first wave of the crisis, which would be losses on subprime and Alt-A, $200 billion? Is the financial sector supposed to be so strong, and we as actors, that we are supposed to be ready to handle the failure of a Lehman? Or is are we accountable for that? Or is the financial system, as you idealize it, supposed to be prepared for that, and the failure of Goldman too? So where's contagion in what you're thinking about here? And I know we're on the record, but no one will tell if you're going to say, I'm prepared to be a lender of last resort.
No, but at the end, I think you again also answered your question. It's a balancing act. Of course, if you are so resilient that you can withstand and weather every event that you can foresee, then of course you will probably not able to run your business anymore. So it's a balancing act between the likelihood of certain events and the capacity of the financial industry to serve the economy at the end. And we, I think, are shifting this line more towards the resilience these days, more towards the resilience of financial institutions to increase their loss-absorbing capacity. This is one thing. We're tightening our supervision. It's not only the loss-absorbing capacity, it's also our supervision that in a way was neglecting, I think, some elements. So in that sense, we are shifting the line somehow, but of course it's not a corner solution that we're striving at.
So you do care about contagion?
Of course we do care about contagion. The question is, with what head-on do you ask me to take care of contagion, or who is taking care of contagion? Is it the fiscal authority? Is it the monetary authority? And I would say in most of the cases I can think of, it's the fiscal authority that has to take care of contagion. Our task is to lend to solvent banks and against collateral. In some cases, with our emergency liquidity assistance, I mean more freely, but at a penalty rate. But if you have banks that are insolvent, if you have to wind down banks, this is not our business anymore. This is the business of the fiscal policymakers, because it's involving taxpayers' money. And as soon as taxpayers' money is involved, I think you have to justify yourself in front of your voters at the end, because you decide on how to use that money to bail in or to let the bank go under and so on, or to bail out, bail in or to bail out. So it's a matter that needs democratic control. I mean, I would feel uncomfortable leaving these decisions with consequences for taxpayers as impressive as these that we've seen in the hands of unelected bureaucrats that you cannot even vote out of office or kick out of office. This is something for, and I would be, I mean, rather feeling uncomfortable as a voter if that would be taken out of the realm of politics. It's a political decision. It's not a decision of central banks.
I hope you have noticed the shudder going around the room as Americans present think about lender of last resort activities being undertaken by the 535 members of the United States legislature.
No. But this doesn't mean that you have, I mean, you have a government, I hope. And the government is the first line, and then...
we hope as well, but we hope as well, and hope springs what? Yes.
Because for the, I mean, again, for these decisions, you need, I think, democratic accountability.
Are there other questions for Dr. Weidmann before we conclude? Well, one right behind you, and then Andre.
Let me just, I mean, before I get the next one, because I think this is at the core of the debate we are currently having. I mean, we are a very strange animal in a democracy. You have an institution that is basically outside democratic control, that has a degree of transparency that varies, and this is in a way foreign to a democracy. The only way to justify this exclusion from democratic processes is if you very narrowly limit the scope of this institution. Because what happens, and we saw this during the crisis, so this is not an abstract fear of a paranoid central banker. What happens is if you impede in the area of fiscal policy, and I agree, to draw the borderline in the crisis is much more difficult than in normal times, is that you will end up, or those that normally will have to take these decisions, will end up asking themselves, so, hey, wait a minute, who are these guys taking all these decisions? If they take these decisions, we have to control them. And then you end up losing your independence. And these days, our independence is in a way questioned by two sides, also from the academia, if you want. On one side, those that ask us to do ever more, the central banks as only game in town, and the other side from those that think that we have gone way too far already, and thus should be, restricted in what we are doing. And in that sense, we risk losing, I think, one of the key ingredients to our capacity of ensuring price stability.
Over there.
Yeah, Dr. Weidmann, thank you very much for the fascinating speech, first of all. So you were talking about putting a cap on sovereign debt holdings for banks, And I do agree with you that this is definitely a big problem, especially if it's focused on just one country debt. But so I could only imagine two ways on how this could work, actually. The first being very unlikely, governments have to reduce the debt overall so that that they issue less debt, which is rather unlikely. And the second would be you just shift the problem of those less secure debt to probably insurance companies or a shadow banking system that hold these debts then. So what do you think about that? And do you think it, like having a Eurobond or a common borrowing scheme that spreads the risk and makes borrowing less dependent on one country's risk would be a good solution?
Well, the latter is certainly true. It makes Eurobond would make the whole thing less dependent on each single country. The question is whether Eurobond makes sense in the current institutional setting. I mean, does it make sense? I mean, I'm borrowing a very drastic example. Does it make sense to go shopping on one credit card? You would probably not agree if that were on your account. So I would say Eurobond might be part of the institutional setup if we are ready to cede sovereignty to the European level. Then you are in let's say, the option I portrayed, which is that of a political union. And if you share decision-making powers, if you take joint decision in very important policy areas, then of course you can also be jointly liable for those decisions. But if we all make individual decisions on how to spend our money, and we are jointly liable for the result of all this, I'm not sure that the outcome of this is really a stable equilibrium, or at least a bank account that your bank would like to maintain for a while. So yes, but not in this. And what worries me or what bothers me sometimes in the debate is that we discuss this only from one angle. Eurobonds is a solution from the crisis, but if you ask the same protagonist that suggests Eurobond, are you willing to go to your parliament and ask your parliament, tell your parliament that no, it won't be you anymore deciding on our budget. There is another authority in Brussels that has a say on our budget. The same people will tell, no, we'll never do this. This is absurd. Why should we cede national sovereignty to these guys in Brussels? But then I think it has to be clear that then this will not work. Then Eurobonds are foreign to this setting. I think who holds government debt? At the end, I think the key is that is the systemic nature of the agents holding the sovereign debt. So it's about spreading the sovereign debt more broadly. And I'm sure that in the case of the states, I mean, the indebtedness of the states is not comparable to the indebtedness of the European countries. But at the end, the exposure is probably not as concentrated also
Correct.
as in our case, which is one of the key differences, and that's exactly what I'm talking about. So insurances are one, but they're already holding a lot of sovereign debt, but also other actors of the financial system or you.
Mm-hmm. Although there is a conceptual aspect of the question you're asking, which is very interesting, and that is that, especially if Europe pursues the path that you're outlining, in which it's very clear that there is no central authority that stands behind the bonds of the individual sovereign states, then in effect Europe does not have what we would call genuine government bonds, namely bonds issued by an authority that has the right to print the currency that in which the bonds are denominated. What makes U.S. treasuries and UK gilts and Japanese JGBs, what makes them government bonds in our sense is that the issuing authority is also an entity that has the right to print the currency in which the bonds are supposed to pay off. And so barring, there's never an issue of whether they could pay. There's always just an issue of whether they will choose to pay. And Neil will correct me if you can think of one, but I can't. I cannot think of a major size Class A economy in world history, modern world history, that has functioned without government debt. I can't think. Can you think of an example? I'm not coming up with one.
The exception in that story would be all those governments of substantial size that had to borrow in gold-denominated bonds in the era of the gold standard. The Russian case leaps to mind.
I said a Class A economy. I'm not including things like that. Yeah, I mean, I understand there are these basket cases around, but for serious, thinking Japan, Britain, the United States, France, I'm thinking of Germany before the monetary union, I'm thinking of serious Class A economies. They tend to have government debt. And in some sense, this is a very interesting experiment if Europe goes down this road in which it's going to be a serious, first-class, sizable economy with no government debt. That's going to be very interesting.
Works. I mean, that's why we have all these complicated rules in our treaties, because that was an issue that we were pretty aware of from the start. I mean, it's a peculiar setting where you decided not to share any fiscal or shift around any fiscal burdens between the taxpayers of the different countries. And if monetary policy were to be the lender of last resort, this would, of course, be tantamount to communitizing debt and to shifting around these fiscal burdens. So it's completely foreign to this setup. You would undermine this setup, and it's clear that it won't work if you, I mean, if you don't fix the Maastricht framework.
Last question, Professor Schleifer.
I wanted to go back to something you've raised, which is structural reform. Now, I think it's probably fair to say that for the South European economies to be weaned off the ECB assistance, it's, as you said, it's necessary for them to become more competitive, and that probably requires structural reforms, reforms of labor markets, reforms of product markets, and so on. As I see it, there is very little desire in those countries to undertake structural reforms. But you actually see that in doing business indicators, or however you look at it. In Greece, there is none. In France, it's God forbid. In Italy, there is very little. In Portugal, there is a desire to do some, but the Constitutional Court says no. Maybe there is some in Spain. So it seems to me that I just want to understand your reaction in the world in which, and it's still a question about the speed of transition, in a world in which Southern Europe in all likelihood is not going to undertake structural reforms of any significance. How are your institutional changes going to be anything other than pie in the sky that might become relevant in some very distant future?
Yeah, I think your view on Southern Europe seems to be a bit too negative to my taste. I think you're being a bit unfair to Spain, for instance. But where I think we've seen, I would say, impressive reforms, for instance, regarding the labor market and on the structural side more broadly. Greece, for instance, if you look at the fiscal side, has undertaken a tremendous amount of fiscal consolidation. So just to name two of them, I would agree with you in the sense that the countries that are not under program probably face more political difficulties in addressing the challenges they face than those that are, I mean, closely supervised by the Troika and receiving a lot of external pressure, which in a way also might help you politically to push through the necessary reforms. Because you can go to your parliament and say, listen, this is a necessity. We are, again, we would say we are forced to do this now if we want to benefit from the different rescue mechanisms. So it's the program countries with mixed success, but more or less are, I think, following that path. it's a bit more difficult for those countries, and I would, again, not only look at France and Italy, but also Germany, not try to single out any single one of those countries where you don't have this external, let's call it support, or this external pressure to act. Then the political processes are much more difficult. But it's, for me, it's clear, and I guess also for you, if there's not the political will to address these structural challenges, then it will be very difficult to conceive how the monetary union will continue to be a stability union also in the future. If you have a widening heterogeneity in the currency area, it will be more and more difficult for the ECB to establish, to preserve price stability. That's why we're putting so much emphasis on the structural reform and trying to convince governments to continue on that road.
The time has come to say thank you to everyone who has participated. Thank you especially to everyone who asked questions. Thank you to the Center for European Studies for sponsoring this program. Please remember it is not yet funded, and so your check in the mail would be much appreciated. I'm not connected with the Center for European Studies, but I can happy to make the advertisement. And Dr. Weidmann, thank you very, very much for a splendid discussion.